Great. Well, I'd like to welcome Michael Harvey back to his regular monthly slot with Seedlab Tasmania. It's fantastic that you make this time available to us. It's very much appreciated. Today we've got a couple more people from the pod, which is fantastic to see. Really good to see you there. Welcome, welcome, welcome. And we're very much looking forward to today, all about how to value your business. So without further ado, I'm going to hand over to you, Michael.
Thanks, Hazel. I enjoy these sessions. It's sort of good to just sort of collect the thoughts and experiences over the years and sort of share it amongst the group. I'll just share my screen. Find the right one. All right, as Hazel mentioned, how to value your business. So initial question is what are we actually valuing? What's the business? So pretty much there's two components. There's probably the more obvious assets of the business. The accountants call tangible assets, so things you can touch and feel. So that's equipment, things like that. And then what you have called intangible assets, so things you can't touch. Another name for that's goodwill for the business. So just a little bit of sort of background. Also, I liken it to say, well, what's in the box, I suppose? What are we buying at the end of the day? So there's two aspects when you're buying a business or valuing your business. So one is what the accountants and business people call your enterprise value, which is effectively the assets for the business. So if I go and buy, another accounting practice, for example, I'm probably buying the client book and buying the asset as such. Whereas look at the next dot point, equity value, which is the enterprise value less liability. So that tends to be if you buy, say, shares in another business, you're buying their balance sheet as well. So it's just a sort of important background check when you do valuations. So what are you actually buying? And I was chatting to my daughter the other day about, it was just a coffee shop next door to me, and it was for sale. And she said, well, why would you buy that versus starting it from scratch? So what are you buying? Effectively, you're buying future cash flows. So you're bringing forward in your purchase price what the cash flow would be for that business in X number of years. Compared to if you're starting a business from scratch and you have to wait that X number of years before those cash flows catch up to that purchase price. So that's effectively what the whole essence of what a business, why you would value a business and buy a business. So three aspects you're looking at for cash flows. You're looking at how reliable are they? What's the level of probability that those cash flows will be achieved? And what are any risk factors? We'll go through some of those as we go through the presentation. So looking at your risk factors, what are the probabilities and the risks involved with buying a business? The technical term is capitalisation risk. So capitalisation is effectively the number of years or the timeline that you put in place for that return on your investment to come to fruition. So things you're looking at for within a business. So if there's any long-term contracts that are in place. So if I buy a business tomorrow and then those customers the next day can free to go elsewhere and they're not locked into a contract, then a higher risk is likely to be attributed to that particular purchase. We're looking at a pattern of profits for the business. So general rule of thumb, you're looking for a minimum of 3 years as a fairly good snapshot of what the pattern looks like for business profits. Usually where profits there, profits, cash flow, maintainable earnings are all sort of relatively synonymous terms, but to give an idea of what we're looking for. Looking at barriers to entry. So you're looking at, so one of my clients had a fish farm, so there's quite high barriers to entry in terms of either licensing or capital expenditure required. So that's more likely to have a return on investment when there's higher barriers to entry, because the level of competition or how someone could start up tomorrow and compete with you is reduced. You're also looking at your licenses or intellectual property, your IP. And then if you've got really strong IP, either formally in terms of trademarks or informally in terms of systems and processes or knowledge of that particular industry or the business, then the likelihood is it's a lower risk for that to be purchased. Therefore, a higher price tends to be paid for that business. So you're looking at valuation methods. So I just listed 4 there. There's probably a couple more. These are ones predominantly a capitalisation of profits. I'll put in there FME, which is future maintainable earnings. What that's trying to show is that at the end of the day, what's the best estimate, or what's the estimate of what maintainable earnings year after year that business is going to produce for you. And then the valuation method is to multiply your profits, your estimated profits, by a capitalisation rate. For want of a better term, it's sort of either return on investment, some people call it, or the number of years of profits that you want to buy. Another method is discounted cash flow. I don't see that an awful lot. You do see that at probably the next tier up from small businesses, where you might look at the future cash flows and CapEx, and they apply what they call a discount rate or a effective interest rate to come up with what does the cash flow look like. It's a bit of a technical one, but I do see that from time to time as another way of validating an initial valuation method. Then you've got pretty much just asset values. So that's pretty much just looking at your more tangible assets. So some businesses are just based purely on what they bring to the table in terms of the tangible assets. It tends to be probably more if someone is looking to bolt on a business or enter a business, and they're just buying those assets. And the other method is comparable sales. So once again, I'll just use my industry example. There's some rules of thumb in that particular accounting industry and finance about, and they actually use an old method which is sort of being phased out, where that's a percentage of revenue that you're buying rather than necessarily profits, because you tend to buy what they call the client book in my case. So you're looking for comparable sales or industry standards as well. I'll just flick up an example. My laptop should be right. Hopefully you can see it's a bit smaller than I was planning. So just an example, on the far sort of right-hand column, we've got a column called average of the past 3 years. So typically that's what's used as a basis for to look at some of the, what's happened in the past is a predictor for the future. When you come to do it, often you're looking at reliability of that information. So typically during what's called a due diligence process, if someone's looking to acquire a business, they're looking to reconcile that profit back to an income tax return, or audited financials. I don't see many businesses, but bought and sold value that are audited. So typically the tax return tends to be it. And then some adjustments are made to that profit. Another term that comes up sometimes is EBITDA. So it's earnings before interest, taxes, depreciation, and allowances. Bit of a mouthful. What it's trying to do is just sort of add back some what you might call some non-cash items. In this case, depreciation and interest, to come up with what is the underlying cash flow that the business produces. So 180,000 in this example. It's a little bit flawed in a technical sense, but gives a flavour to say, well, we add back depreciation and interest. The reason why you do those is depreciation can vary depending on the nature of the industry and how items get depreciated. And in the year concerned, it's not actually a cash outflow. And interest tends to be related to that particular business. And if I buy one, I might have a different borrowing level than the existing owner. So those tend to be added back. Then typically you might see a few other adjustments that get made to come up with what what's called normalised earnings or future maintainable earnings. So normalised, you may see it in press sometimes. It's trying to extract any one-off items, or sometimes in small business, you might claim a motor vehicle, but reality is the business probably doesn't need the full cost of that motor vehicle, so you might add back an estimate of what's not really required to operate that business. Another one I haven't put there is a bit of a contentious issue, is owners' wages. That depends on the nature of the business. So if I had a client from yesterday, he's a home handyman, so makes a profit, but a percentage of that profit is for the business, and a percentage of that profit is really for his own labour of actually being on the tools. So it's a little bit of a contentious one to do an adjustment for that, but certainly that needs to be taken into account. So in this example, 180,000 of normalised earnings, and then you value that, and in this way I've used a pretty simple capitalisation method of 20%, so effectively 5 times the earnings of what you would pay, all things being equal. 5 times is probably at the upper end of the range I see for most small businesses, but as I said, sometimes some specialised businesses might be 8%, or 8 times sort of annualised earnings. So it gives an idea of sort of some of the fundamentals in that example there. I'll just go back to my slides. So having said all that, then we have in market, I use a publicly listed, the stock exchange, as an example. Then we have Afterpay. So in public companies, those listed on the stock exchange, there's a good ratio that's calculated, what they call the price to earnings ratio, or an earnings multiple. So it's the current price of the share compared to their annualised profit. So how many years would you wait effectively if you bought a share at that price today? So it's a pretty good rule of thumb to see what's happening in the marketplace. So then we use all that theory and all that practice that I've just mentioned, and then you have, I suppose, the emotions and the less logical approach. So you have companies listed such as Afterpay, where it doesn't actually have a price to earnings ratio because they actually never made $1. So, but you've got a share price that is actually based on a multiple of future revenues, which is, quite illogical as an accountant looks at it, but the stock market's giving it the thumbs up because it's, it's a worthwhile investment. And then you look at another example, Xero, the accounting software that I use and recommend. That's actually made profit in the last couple of years, but their share price is over 3,000 times what their annual profit is. Then a couple of other examples to give you an idea that it's not all skewed at one end. So you got BHP, sort of staple of the stock market, that trades around 15 times multiple. Costa Group in the food industry, 8 times multiple. Whitehaven Coal, 5 times multiple. So it gives you a sort of, having said all that of how to value a business, then there are some, I suppose, attributes at play that are more at the emotional level, or other rationales, not just a pure, I suppose, analytical approach. So you look at things such as Whitehaven Coal, very much marked down because, consumer sentiment or investor sentiment is quite negative towards old power sources. So Whitehaven Coal gets marked down. You look at something like Afterpay and Xero, gets marked up at the moment because the market sentiment is that it's about everyone's going online, everyone's sort of transacting in electronic format, and these revenue sources are going to be great to do value adding down the track. So I just wanted to put out there that, I can, or any valuation that can be done, at the end of the day, a market price is still going to be set between a willing buyer and a willing seller. So sometimes the willing buyer may be more motivated than others because of either they see a great opportunity with that business, or it's a great fit in terms of a bolt-on or synergies for a merger, something like that. And then it could be a negative where, I don't know, say if I valued a video store a few years ago, you know, the whole industry's being shut down, so I could have done a valuation based on the past 3 years' profit, but the sentiment would have been, well, it's highly unlikely that it's going to produce a profit in another 3 to 5 years' time. So then, that said, how do you prepare your business for valuation or to come up with the right value? So I still go back to sort of the more analytical approach. So you are looking for consistent cash flows because that's typically going to be more reliable going forward. COVID's thrown a few spanner in those works of what it can do, but I still maintain strong businesses will still produce strong, consistent cash flow down the track. You're looking at contracts. As I said at the start, the better the contracts in place, the more likely that revenue will continue and that profit will continue going forward. And then you're looking at client lists. Often businesses want to buy a business purely to tap into that client list, so either to offer additional services that they are not currently providing to that client list, or to provide increase their sort of sales and profit margins. You're looking at intellectual property and licenses. So how strong are those? Such as, you know, like an abalone quota or something like that is very, very strong in terms of valuation because it's a restricted market. Then you look at intellectual property, such as, you know, if you've trademarked certain operations. One of my clients is into recycling, and they've trademarked quite a unique way of recycling plastic, and so their valuation of what people are prepared to pay for their business is miles ahead of what the pure consistent cash flow would demonstrate that business is worth. But people can see the opportunity and see that's an issue going forward, the whole recycling industry. You're looking at systems and processes, and I should have probably put in there your people as well. Another client sort of in, what would you call it, sort of a wholesale area, and they've been approached by one of their competitors to look to buy them out, and their attraction purely is the staff, because they've got a really settled staff, and they're seeing roadblocks for their business growth because they can't find the right people. So systems, processes and staff can be quite valuable as part of that. I always say to people, have the type of buyer in mind. So always think about what an exit looks like for your business and what type of buyer in mind would typically come in and buy your business. So it could be that, you know, you need someone cashed up, or you need someone who's a different demographic, or sometimes it's, you know, I say to people like the home maintenance guy yesterday, I said, maybe your buyer is going to be someone who moves from the mainland, you know, when the borders are open, and they sort of, you know, fits their sort of lifestyle. So just to have that at the back of your mind at any point in time, to what type of buyer is in mind, and have the business ready for sale. One of the big ones is separation of business from your owner. So how much of the goodwill, if I go and buy a business tomorrow, how much of that goodwill is related to the business? And if the current owner sells off into the sunset, then how much IP do I lose? How much client base do I lose? How much momentum? So that's sort of a real trick. And it can be whether it's farming businesses versus service businesses, like say myself and Hazel and Darren. That separation is how much are they buying for Michael Harvey versus MDH accounting, as an example. So it's a real tricky one. But the more distance you can put in place and the more that you can demonstrate that you've got systems and processes, the better it is. What else we got? Oh, that's it. All right, I'll stop sharing and see if there's any other questions.